Today, I'm sharing my take on Novo Nordisk, why the stock has dropped so sharply, and why I think it's a buying opportunity right now. Plus, the Fed is set to release July's Consumer Price Index this week. We'll talk about what to expect and what experts are saying. Novo Nordisk, NVO, is still an undisputed leader of the GLP-1 revolution and an all-around top pharmaceutical company. But despite its blockbuster drugs and dominant market position, the stock has underperformed in recent months, falling nearly 15% from its all-time highs. Some investors see this as the end of the GLP-1 trade and perhaps the beginning of some very difficult years for healthcare companies as headwinds mount. However, I see it as a rare opportunity. With a robust pipeline, strong manufacturing expansion, and international momentum, Novo remains one of the best long-term growth stories in pharma. Buying this stock right now is very attractive, with a plus 3% yield and plenty of room for capital appreciation. This price won't last long, in my opinion. What happened to NVO? NVO has been caught in a perfect storm of high expectations, sector rotation, and rising competition. After a multi-year run that made it Europe's most valuable company, the stock has now seen almost a 60% decline in the last year. But the Q2 earnings may have finally shifted sentiment and given us a bottom, with the stock now up over 10% in the last 2 days. In Q2 2020-2025, Novo reported revenues of DKK 65.3 billion, which is a 22% growth year over year in constant currency. Operating profit came in at DKK 31.5 billion, up 23%. GLP-1 drugs continue to be the engine, with Wegovy sales jumping 67%, while Ozempic rose 35%. North America remains the biggest driver, with 27% sales growth in the region, but international markets are quickly catching up. Japan, for instance, saw a 91% increase in GLP-1 sales thanks to strong Ozempic demand. Obesity care sales nearly doubled year over year and now account for over 18% of total revenue, up from 12% last year. However, production constraints in certain regions prevented even higher growth. Despite strong results, it's also true that NVO trimmed full-year guidance. Sales growth is now expected at 21 to 25%, down slightly from 22 to 26%. Novo also cited higher-than-expected rebates and changing payer dynamics in Europe as potential headwinds. And although in many ways NVO is doing great, it is true that GLP-1 growth has been slowing down. But this doesn't change the bigger picture. Demand is still far outpacing supply, and Novo is scaling rapidly to meet it. In my humble opinion, this correction in the stock is creating a very attractive long-term entry point. Here's why I'm buying. Dominance in GLP-1s. With over 65% market share in GLP-1 therapies, strong brand recognition, and years of safety data, it has a wide moat against competition. Yes, there is stiff competition from Eli Lilly and potentially compounders like Hims. Moreover, Novo has shown superior performance in their latest pill version of Wegovy versus Lilly, and this is very encouraging. Wegovy is expected to launch in tablet form in 2026. Manufacturing expansion. Novo is investing billions to scale production. Its fill-finish capacity is expected to double by 2026, and the Clayton, NC facility will begin delivering doses next year. This will be key to meeting pent-up demand and expanding access globally. Strong pipeline. Novo is developing next-gen obesity therapies like cagrilintide and amylin analogs, which could offer even greater weight loss and metabolic improvements. There's also plenty of potential for amycretin. GLP-1s are now being explored for a range of conditions, from Alzheimer's to NASH to cardiovascular disease, and Novo could be at the forefront of multiple therapeutic revolutions. The obesity treatment market is projected to grow to $100 billion plus annually by 2030. Novo already dominates this space, and there's also room to grow in the rare diseases segment. Valuation. NVO trades at around 12x forward earnings and 4x forward sales, and the company is deploying capital efficiently. The stock is now undervalued compared to its history on a lot of metrics, and I believe it won't take long to recover. With that said, we can't deny there's a reason the stock has fallen so much in the last year and risks remain. On the valuation front, it is true that the forward price cash flow is very rich. Indeed, NVO is going through a process of heavy investment while it struggles with margin and pricing pressures. In this regard, President Trump has clearly waged war on pharmaceuticals, and Novo could still take a hit over the next year or two. There's also a risk that supply won't keep up with demand and competitors may seize the opportunity. Novo is still firing on all cylinders, yet trading at a discount relative to its growth and long-term potential. GLP-1s are changing medicine, and Novo is ahead of the competition. With new facilities coming online, oral drugs in development, and global demand still exploding, I see NVO not only rebounding, but potentially doubling in the next few years. I just bought some shares today. Now, on to the CPI report. This Tuesday, the Labor Department will release the latest Consumer Price Index report for July, and it comes at a critical moment for the economy. The Fed is watching closely, especially as new tariffs begin to push up consumer prices ahead of their interest rate decision next month. Economists expect inflation to tick higher. Goldman Sachs projects headline CPI to rise to 2.8% year over year, up from 2.7% last month, with core CPI, which strips out food and energy, climbing to just over 3%. Tariff-affected categories like furniture, auto parts, clothing, recreation, personal care, communication, and education are estimated to add about 0.12% to the monthly CPI increase. Looking ahead, Goldman thinks tariffs will keep monthly core inflation elevated in the 0.3 to 0.4% range, and by the end of 2025, they expect core CPI to be around 3.3%, or about 2.5% without the tariff impact. Headline CPI, they project, will end the year near 2.9%. JP Morgan's forecast is in the same ballpark, a 0.3% monthly increase for July, pushing headline inflation to 2.8% annually, and core CPI to roughly 3.1%. They also warn inflation could run hotter if companies start passing more of their higher costs onto consumers. We've had strong earnings reports these past weeks, and I think the overall economy is doing well despite the fear in the news. I'll keep buying strong companies and staying invested for the long run. That's all for today. See you in the next one.